US markets are at all-time highs. Feels good, doesn't it? But what if I told you that this rally is being led by just 6 stocks and cracks are already showing the underneath? Today, we break this illusion and guide your portfolio through the noise and what it impacts the Indian markets. Hi, this is Prabhanjan Rao from Elysian Investment Advisory. We are a SEBI registered investment advisory providing curated long-term solutions for wealth creation, lifestyle planning, retirement planning, last but not the least, estate planning. I am also a chartered accountant and a cost and management accountant from India, having more than 22 years of experience in the similar fields. A quick disclaimer, the following content is only for informational and educational purposes. It should not be construed as an investment advice whatsoever. Please consult your financial advisor before making any investment decisions. Stock market enthusiasts, we will cover in this video the global updates during the week in markets like US, China, Europe, and its impact on Indian markets. Indian markets have been very resilient during this week in spite of global turmoil. We will also touch upon Brent crude, US dollar index, volatility index, and India's macroeconomic story. So stay tuned till the last. US mega cap illusion. The US markets are making headlines and highs, but you dig deeper, you will see that the 6 stocks like Nvidia, Amazon, Microsoft, Broadcom, Meta and Apple, they are doing the heavy lifting. Why does this matter? Because 85% of the rest of the S&P 500 isn't performing. It is underperforming this index. This is not a healthy participation. It is a momentum bubble. Narrow leadership equals fragile rally. If you are buying this S&P now, you are effectively betting on 6 names. Diversification? Absolutely not. It's a myth. Right now, you are more concentrated than you think, is it not? Are US tariffs a monetary tightening? Everyone's talking about tariffs as a trade war, but from a market lens perspective, it's actually a monetary policy tool. Tariffs increase prices. Higher prices push inflation up. That pushes bond yields higher and that dries up liquidity. No Fed hike? Doesn't matter. The bond market is doing the tightening for them. Isn't it what is happening during the last week? Equities are still pricing in soft landings and rate cuts, but the bond market isn't. The divergence? It's dangerous. It means equity valuations can get blindsided by yield spikes. Is Fed pause a mispriced equities? Strong jobs, sticky inflation, but the Fed's on pause. Isn't that great? Actually, no. Markets assume a pause means more room for tech to run. But if the Fed isn't cutting and inflation doesn't fall, we stay in a world of tight liquidity. In fact, a very tight liquidity. That's not a tech rally. That's a rotation to value, to cash flow, and to real yield. This isn't a crash. It's worse. It's a slow grind where high duration stocks bleed quietly. Watch sectors like utilities, dividend yielding stocks, and the real asset backed players. That's the way you should play in the US if you're really trading in US. The crude, dollar index, VIX, they're very calm. Is it a calm before the storm? Let's talk the macros. Crude is inching up to $70. Dollar index is about 98.16. The CBOE VIX index is 16.39 and the VIX is at 11.39. On the surface, it looks very calm, but VIX under 14 usually means complacency. Crude rising quietly and strong dollar always puts pressure on the emerging markets like India. It's not just about the oil prices, it's about what the signals are, the tightening financial conditions worldwide. China and Europe, hidden fragilities. Let's decode some optimism. Let's get on to China. Banks are yielding 5%. Sounds great? Not really. High yield is always a high risk. Policy support is helping sentiment, but structural issues remain in China. Now let's get on to Europe. ABB-SAP gave strong set of earnings, but US tariff threats wiped out gains. Germany, the EU are too export dependent. Retaliation risk from the EU adds another layer of uncertainty. If you are exposed to China or European Union markets, hedge or reduce allocation. So, where do we stand now? US rally is narrow and very fragile. Tariffs are the new rate hikes. Fed pause is not a gift to take, it's a trap. India is a standout, but play the right sectors. The crude, the dollar, and the VIX suggests this calm won't last. Stay data driven, rotate where needed, don't chase highs, chase the logic. India's stability lies in its structural edge. While the world juggles with inflation, yields, and tariffs, India is quietly becoming boring. Indeed, very boring. But boring is good, is it not? What are the key strengths? Forex reserves at whooping 640 billion, CAD under 1.5%, inflation steady at 5%, RBI is neutral, not confused whatsoever like any other central banks. India is no longer a high beta emerging market play, it's a domestic demand structural story. Think private banks, infra, manufacturing, and not just IT or tech. India is becoming the Switzerland of emerging markets. Not exciting, but incredibly investable. If you find this video helpful, like, share, comment, and subscribe. For short, sharp updates, check out our reels. Until next time, invest smart, stay safe. Have a super Elysian day.